What is the GLP or GAP? GLP is guideline level premium, or guideline annual premium is GAP. What is that as it relates to indexed universal life? This is critical. I'm going to do a deep dive into explaining this next. So I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for 5 decades, helping thousands of people optimize their assets, minimize taxes, and empower what I call their authentic wealth. Now, if you've watched very many educational videos on my YouTube channel, I'm very passionate about helping people understand how to accumulate, access, and transfer their money totally income tax free. And so my favorite financial vehicle to do that is a properly structured, maximum funded, indexed universal life insurance contract. Because if it's structured correctly and funded properly, you're self-insuring, okay? What does that mean? It means that you're designing this insurance contract so that it will grow to be totally tax-free, so that it will generate tax-free income at a rate of return that'll knock the socks off of most IRAs, 401ks invested in the market, okay? Now, a lot of people don't understand what we mean by max-funded indexed universal life. They have these myths out there like, oh, I know that universal life is going to get so expensive. As you get older, it's going to implode. It's going to crash and burn. The costs are way too high. Those critics, they don't know what they don't know. They don't understand IUL. When you're max funding IUL, okay, this was the original thought process of the brainchild behind the emergence of this, which was E.F. Hutton, okay? They weren't primarily an insurance company. They were a brokerage firm. And they realized that a lot of people had their money in the market if they earned 12% average rates of return, which most people don't. You're not netting 12%. If you had $1 million nest egg and it was earning 12% during retirement, theoretically, you ought to be able to pull out $120,000 a year without depleting principal, right? Well, that's not all your money. If that was a tax-deferred IRA or 401k, you pull out $120,000 and you're only netting $80,000 in a 33% tax bracket. And then there's fees. They usually charge 1% asset management fees. So you subtract the fees and you earn 12 to net 7. All E.F. Hutton said was, why are we doing that? Some of the best money managers in the world are the multi-trillion-dollar life insurance industry. And so that's the backbone of America, the backbone of the world. And some of these companies manage more money than the IRS collects in taxes in an entire year, just one company. So these insurance companies are the best money managers. And all E.F. Hutton said is, golly, under Section 72E and 7702 of the Internal Revenue Code, now for over 108 years as of the recording of this episode, money inside of a permanent life insurance policy accumulates tax-free. All the interest and dividends is tax-free. That's 72E. But 7702 talks about how you can access that money while you're alive, tax-free. But Section 101A of the Internal Revenue Code is where it's all centered. That's the death benefit. Because when you buy life insurance, a lot of people buy it to maximize what they leave behind in a death benefit. Well, that death benefit is the risk incurred by the insurance company, but you can actually take ownership and you can set up a life insurance policy to where under Section 101A, all of your money becomes tax-free when you self-insure. So what this means is, if you are 60 years old and you want to reposition $500,000 into a max-funded IUL, you're wanting that $500,000 to grow, to double to $1 million, to $2 million, to $4 million, to $8 million, tax-free. Well, under the TeFRA and DEFRA tax citations, TeFRA is the Tax Equity Fiscal Responsibility Act of 1982, and the Deficit Reduction Act of 1984, those two tax citations dictate the minimum amount of life insurance, death benefit, that you have to start out the contract with so that it will be tax-free. It will not exceed the definition of tax-free insurance under those sections of the code. And so TeFRA and DEFRA dictates, well, you have to have a commensurate amount of insurance attached to the account. Okay, but your objective is living benefits. So if you were this 60-year-old male and you wanted to reposition $500,000, you can't put it in all at once, but you can get it all in there in about 3 years and 1 day or 4 years and 1 day, depending upon your age. So when you do that, the $500,000 is finally in your policy in compliance with the TEFRA tax citation. Let's say, 4 years and 1 day into it is the fastest you can do that. Well, that $500,000 now, if it's growing at a nice indexed rate of return, averaging over 9.6%, which many of our clients have been averaging in the 10s and 11s, you can learn about that on my YouTube channel and see actual evidence of that under Does IUL Work? 9.6% is extremely conservative. I've averaged that since 1980, okay? 9.6 into the rule of 72. Divide that into the number 72, and your money doubles every 7.5 years. So once you get $500,000 in there under the IRS rules, that $500,000 doubles to $1 million, and then to $2 million, then to $4 million, and then to $8 million every 7.5 years. We've had people who started out with $500,000 and they have $8 million tax-free 30 years down the road. So far, so good. Now, the 60-year-old male, when he's starting out, he wants to put in $500,000. He could buy a lot of life insurance for that, but that's not the objective. He wants the least amount. Well, under 7702 right now, he only needs about twice that, $1 million of death benefit. So far, so good. So he's going to put $500,000 into $1 million death benefit, and people say, well, who pays $500,000 for $1 million of life insurance? Well, our clients do, because they're not doing it for the death benefit. They're doing it to own the death benefit, to convert their $500,000 into $8 million tax-free. How does that work? He puts in $500,000. Now, if you happen to die, the insurance company pays out $1 million, but $500,000 of that's your own money. And some people say, what? The cash value is gobbled up in the death benefit. Well, the chances are you're not going to die that soon. If you do, yes. But a $500,000 blossoms to $1 million. That's still a good rate of return if you die. That's not why you did it. You did it so the $500,000 grows as fast as possible, and the cost of insurance gets cheaper as you get older. Did you hear that? Now, a lot of times people say, I've never seen a life insurance policy that gets cheaper as you get older. And these are the naysayers who don't understand what I'm talking about here. When you have $500,000 in $1 million death benefit policy, the insurance company is only at risk now $500,000 because $500,000 is your own money. When that $500,000 doubles to $1 million in 7.5 years, now you have $1 million and the death benefit was $1 million. There is no risk to the insurance company. The cost of insurance is zippo. Now, TeFRA and DEFRA says if you happen to die, the insurance company will pay out 5% more than your cash value. So if you had $1 million in there, they're going to pay out $1,050,000 if you die. But they're only charging you for $50,000 net amount at risk. The interest on the $1 million is dwarfing the cost of insurance on the remaining $50,000, even though you're 10 or 11 years older. Okay. Now that $1 million, if you don't start taking out $100,000 a year of income tax-free, it'll double to $2 million. If you die, it'll leave behind $2.1 million. But the insurance company is only charging you for that $100,000 net amount at risk. You have now owned the death benefit. 95% of the death benefit is your money. You've converted your money to tax-free under Section 101A because you're owning your death benefit. And that's why the insurance gets cheaper as you get older, because the interest on your cash value is so much greater than the cost of the 5% of death benefit if you happen to die. So if this is like intriguing you, oh my heavens, this will blow you away. So when we talk about these terms, guideline level or guideline annual premium, people get confused and they go, well, what is that? Because so many agents who don't understand this, and they have some clerical person with the insurance company creating a plan, they automatically just put in target premium. Well, target premium, it means different things, but when Universal Life was first introduced, target premium was generally the premium that the insurance company recommended you pay at a minimum, even though that wasn't the minimum premium. You could get away with paying less than that. But if you paid target premium under the worst case scenarios of interest rates, it would keep the policy in force to age 65 or some number like that. And target premium is also what the compensation or commission is based upon that's paid out to the licensed insurance agent. And so a lot of times, people who don't know what they're doing, they just plug in target. Well, the target premium might be, $300 for a policy with X amount of death benefit. The guideline annual or guideline level premium might be $600 or $900, double or triple that. And so if you're going to maximum fund it, you don't want to just put in target because that's way down here. The objective is to put in the most money, or if all you have is $500 a month to put into one of these, then you don't make $500 the target premium. The target premium would be maybe $200. You're solving for this. The guideline level or guideline annual premium is the most you can put in, and that will calculate the least amount of insurance. Because if you're using target, you'll have 2.5 times more or 3 times more insurance than you really needed. And so if you earned, 10%, you might net only 5. If I earn 10, I want to net 9. If I earn 9, I want to net 8. I want the cost of insurance. I want to make my money grow at the best net internal rate of return. That's called IRR, internal rate of return. And so that's why it's important to understand this. So if the guideline level premium is $500 and the target premium was $200, then the $500 now will grow at the best internal rate of return. Because if the clerical person says, target's $500, then you're going to have way more life insurance than you need to in order to make it grow. It's not going to grow very well, okay? And this is where the naysayers say, this is going to crash and burn. It's because the people designing it don't understand it. So guideline level, guideline annual is the most that you can put in an average annual premium into an IUL policy without ever being stopped, okay? So if it's $500 a month, basically that you take $500 a month, that's times 12 months of the year, that's 6,000. And this calculation goes out about 11 years. Don't ask me why. The IRS doesn't make sense sometimes with the rules, but 11 years of 6,000 is 66,000, which would be the guideline single premium, okay? That's the most you could put in the first 5 years or into that during the first 11 years without exceeding the definition of life insurance. Now, you don't have to, it's flexible premium. You don't have to put in, 500. You could put in 300 for a while and make up for the other 200. So you can put in $700 a month to make up for that. But you cannot put in any more money the first 11 years than this average premium, guideline level or guideline annual, okay? And if you put that in the first 11 years, you don't have to stop. You can keep putting in $500 a month forever, okay, for the rest of your life. And it will grow tax-free. If you put in more than this, once you hit the GSP, okay, the guideline single premium, which is basically 11 times the guideline level, if you put in that much in the first 5 years, you have to stop. The insurance company can't accept any more premium until the 12th year. And then they'll let you put in 1/11th, basically, of what the guideline single premium was if you filled it up as fast as the IRS allows under TeFRA, which is the first 5 years. So the point is this: once you understand this, then you can calculate the minimum death benefit, and you can get away with less death benefit by far than target premium. And that's why it zings, because your objective is 20, 30 years down the road, because you're using it for long-term goals. If you were to average, like we have, over 11.17 to be exact, if you were to average 11, you want to net 10 cash on cash. Only 1% of your rate of return paid for the insurance that the IRS said had to be there. If you use target premium, if you were to earn 11, you might only net 4, 5, or 6, because the cost of insurance was double or triple what it needed to be. So this is really critical. If this is intriguing you, I would implore you to make sure you go to an IUL certified professional to make sure that it's structured correctly to do what I'm talking about if you want to use it for living benefits. And the first step is study, okay? Now, this book's been flying off of our warehouse shelves. We send out 250 to 500 of these, sometimes 1,000 of these a week. And this is not about me, this is about you. It retails for $20 on Amazon. If you buy it on Amazon, thank you, but I'll gift it to you free. And so if you want a free copy, I require a little bit of skin in the game. You simply go to LaserFund, LASERfund.com, click on the link below, and then you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out this hard copy to you. It's 300 pages, charts, graphs, and explanations. You flip it over. There's actually a second book, which is 100 pages, 12 chapters with 62 actual client stories. And you're going to see how all of this works. And then if you like to listen and learn or watch and learn, there's options there for audio and video format. But there's also an opportunity for you to schedule an appointment with a certified IUL professional. You don't want to go to just any agent that is licensed to sell insurance and say, oh yeah, I sell IUL. Unfortunately, the chances are they will not know how to do what I'm talking about, okay? So I would recommend you talk to a certified IUL professional, and you'll be able to, with no cost or obligation, schedule an appointment, a quick consultation with a certified IUL specialist, and then they can create some illustrations to show you how a properly structured max-funded IUL can work in your particular set of circumstances. So take advantage of that. Go to laserfund.com and see how incredible this is, and you'll see how all this plays into it.